All right. Now, James, if you'd like to start us off with our first question for Michael.
Sure, Michael. I was watching some of your recent interviews, and you had mentioned something I think on the Kaiser report about having an allocation to gold currently, and as well, real rates are currently rising a little bit, so maybe you're not as bullish gold as maybe you may become. I guess the question is, what point do you really feel like you'll become really bullish in gold, and maybe allocate further capital toward it?
Well, I look at the direction of the dollar and I look at the direction of real interest rates. Well, right now, the direction of the dollar might be negative, falling, because of our skyrocketing debt and deficits and our current account deficits. So that's putting pressure downward on the dollar. Makes me want to own some gold. But gold hates rising real interest rates. You got nominal rates are rising, and yet inflation is kind of meandering around 2.1% CPI, the way the government calculates it. So you got rising real interest rates, falling dollar. I'm about 10% allocated to gold. I will increase that allocation when I see both the dollar falling and nominal and real rates falling, which should be shortly after the next recession starts. And that probably will be sometime around the end of this year, according to my best guess at this time.
Now, Michael, I know you recently put out an article about interest rates, and you talked about how, the 10-year Treasury bond is rising, and that just this week, we saw we're seeing the rate at about a 4-year high. And you said that basically it's just going to continue to rise, and that a 4% rate is basically going to be the foundation for it to even move higher. So what does this mean for the bond market?
Well, what I said is that 4% is a floor rather than a ceiling for the 10-year note. I just went back to 2007, which was the last time central banks weren't enamored and myopically focused on bending the yield curve on the long end down to the floor. So 2007, the average interest rate was 4.6% on the U.S. 10-year note. I don't see any reason why we couldn't go back there, especially given the fact that back then the amount of publicly traded debt was $5.1 trillion. Now we're at $15 trillion in publicly traded debt. The deficit was 1.1% back then, and it's headed towards 8.6% of GDP. You have to think about this. You have $1.2 trillion in deficits, and add on to that $600 billion of Fed sales. So who the heck's going to buy all this debt with the U.S. savings rate, personal savings rate at 2.4%, pretty much an all-time low? So yeah, I think yields are going to go a lot higher. They're right now 2.9% on the 10-year. I don't see why the benchmark shouldn't go at least to 4%, and that'll be a floor. A springboard for much higher rates. As rates go higher, debt service costs increase dramatically to the U.S. government. And if central banks continue this ruse that they can actually extricate themselves from these massive balance sheets and this massive controlling of interest rates, then interest rates will normalize, mean revert. This is what happens in nature. It happens in markets too. Mean reversion. That means the U.S. 10-year should be closer to 7% than it is 2%. So yeah, rates are going a lot higher, and you see the effects all around you. I mean, just looking at the housing data that came out this week, where week over week, existing home sales were down 6%, 2 weeks in a row. Home prices have started to fall. For the first time in many, many years. People are getting priced out of homes. As the mortgage rate rises, refinancing, the need to refinance and the ability to refinance is plummeting. So this is one of the things I'm looking at. You also look at the collapse in what I see is the collapse in high yield and junk bond market and the leveraged loan and CLO market. As rates rise, the average yield on high yield is around 5.5% right now. And if the 10-year note goes to 4.5%, well, then, of course, high yield's got to spike. And when high yield spikes, there's going to be a huge rush out of a very narrow door of people who've piled into these funds, these junk bond funds and CLOs. So these ETFs, just like the volatility index blew up, It's sort of like what's going to happen with the ETF market and these bond fund proxies. So I want to say I'm sorry. I want to say one more thing. If you bought the U.S. 10-year in July of 2016, it was 1.4%, and if it goes to 4.4%, you will have lost about 1/4, 25% of your value in a 10-year note. So when that happens, and people start opening up their statements, and for the first time in 37 years, they find out that, oh my gosh, hey, I actually lost, a great portion of my investments in a risk-free treasury note. Oh boy, this is what's going to happen. This is the result. Not my fault. It's not your fault. When you have central banks take over the entire world of investments, they've taken it over. There's nothing that's free market really anymore. They've taken over everything, and then they think that, well, we could just reverse that, and it'll be sort of like, to quote Ms. Yellen, it'll be like watching paint dry. I don't think so.
Yeah, and that we would never have another financial crisis in her lifetime. I'd love to expound on that and pick your brain even further on that, because it's clear that, upwards of $300 billion, give or take, of net total liquidity worldwide from central bankers last year on a monthly basis sometimes was what in fact floated the markets, even though we were living with them orchestrating the meme, the propaganda about quantitative tightening and slimming down balance sheets 18 plus months ago. There's something different in the market now because yields are finally responding, and it does in fact look like the treasury market is not going to be very easily well bid for going forward. And then maybe even we see bond vigilantes coming back to life. When you look at what's happened in 2018 and compare it to how market participants look forward at interest rates, do you think that there's something psychologically in the marketplace that has clicked, that there's a different appreciation? You wrote a fantastic book, The Coming Bond Market Collapse, How to Survive the Demise of the U.S. Debt Market, back in 2013. Your thesis has been spot on, but the amount of liquidity that the central bankers dumped in the market has been beyond imagination, frankly. I think it's surprised absolutely everybody. Do you think we're at a point where they can't make the house of cards stand any further, and that people are recognizing that?
Yes, 100% correct. Very well phrased on your part. You see, I started this firm in the wake of the Great Recession, and I realized that debt levels have reached a point where they have to be defaulted upon, either through inflation or through deflation, explicit default on the debt. Well, you look at the U.S. debt from $10 trillion when Mr. Obama came into office to $21 trillion today. But you look over in Europe, too. Don't forget, we had a European debt crisis in 2012, and European bond yields, especially in the periphery countries, just exploded. And in Greece, they were 200% on the 2-year, 40% plus on the Greek 10-year note. Well, what's happened since then, of course, Mario Draghi came in and vowed to do whatever it takes to make sure the euro was a solvent nation and the euro currency was strong and that the sovereign bond markets there wouldn't blow up. Well, how did he do that? By counterfeiting euros like mad. And now the German Bund is now 0.7%. And what the hell does the German Bund deserve being at 0.7%? It was 4.5 before the crisis. So, I mean, when Mario Draghi steps out of QE, and he's gradually stepping out of it from 60 to 80 to 60 to 30. He'll go to 15 for sure in October and probably to 0 by the end of this year. Well, you're going to see a slingshot effect and then a violent move higher in the German Bund from 0.7 to at least in the 2s, at the very least in the 2s. And God knows what's going to happen with what I call him the kamikaze counterfeiter over in Japan. I mean, he's got a 10-year JGB at 0.6%. I mean, this is an insolvent nation. The debt to GDP ratio is off the charts there, at 250% in the national debt to GDP ratio. and they have an inflation target of 2%. I mean, how is Mr. Kuroda going to be able to stop buying Japanese bonds? He owns over half of them. How is he going to at least communicate to the market that he's now going to be slowing down his purchase of ETFs? He owns almost all of them. So, it's just not going to happen. It's not going to happen with impunity. Central bankers have duped themselves into believing that, hey, we know that we've printed $15 trillion since the Great Recession, and not coincidentally, around $15 trillion at the apogee of bonds were negative yielding. In other words, you can get paid to issue debt as a sovereign nation, and even in some cases in Europe as a corporation, you get paid to borrow money. And then they say, well, if we keep doing this, we keep printing money at the apex of this printing was $170 billion per month, according to my calculations, per month of quantitative counterfeiting, boosting stock prices and buying bond prices and taking yields lower. And then they say, well, if we keep doing this, asset bubbles are already going insane. In the U.S., the total market cap to GDP, which is my favorite metric for valuation, was 150% a couple of weeks ago. So 1.5 times the underlying economy. Well, it was never that high except for 1 month. It was equal to that. Actually, it was 148% of GDP in March of 2000. The asset prices are usually about 50% of underlying GDP, not 1.5 times GDP. So the central bankers said to themselves, well, we have this inflation target. We're sort of getting close. Asset bubbles have gotten way out of hand, and bond yields have gotten way out of hand, even lower than they even thought they would go because of front running. And now they say we have to stop. We have to remove this stimulus. And they have the hubris to believe this is going to go smoothly. Well, when in the history of central banking has a reversal of easy money policies, easy monetary policies gone well?
Never.
It didn't go too well in 1929. Really didn't go too well in 2000. It was a horrific mess in 2008. But those times were relatively benign, innocuous compared to what they've constructed today. So I don't think this is going to end very well. I'm warning investors. I don't want to be a Cassandra. I don't want to sound like I'm anti-American, or I'm not that way at all. I'm here trying to advise people to warn them that the volatility is going to pick up dramatically and chaos is coming to markets. And if you don't have an actively managed strategy, a way to help you make money in all conditions, either inflation or deflation, you're going to find your savings wiped out.
Hey, Michael, I have a question regarding just the overall big picture. Based on BIS and the IIF, at the beginning of 2007, overall global debt was $149 trillion, and that's public and private. Recently, they came out with a figure of $233 trillion, so that's a 56% increase in just over a decade's time, right? So, and historically, to fix a situation where there's way too much debt, it's not a central bank's job to do that. It's really the job of governments to do that. I mean, they basically will have to step in at some point to fix this structurally, I would assume. I mean, if that maybe is an assumption of yours or not, I just wondered if you thought that was true or not, and if it is, and what scenario do you see governments finally stepping in and starting to write off some of this?
You're asking, if I understand your question,
sure.
You're asking me, what would the free market do in a situation where you've gone from, you've added 60, 70 trillion dollars to debt since the Great Recession, taken the total debt to GDP ratio, 330% of the global economy. What would the free market do? What would the free market's response to that? They would be rapidly rising interest rates,
right?
Which would bring more savings. You'd have a recession / depression, be a depression, in my opinion. But savings rates would go up, and the banking system would be flushed once again with savings, and interest rates would come down. That would be the normal function. But I mean, does anybody think that pension funds, both public and private, are going to be allowed to go insolvent? You know, they're way behind. They're already way behind the funding curve. They had these projections of 8%. They've made well short of that. And now instead of just, you couldn't go very low on the risk curve. You couldn't just buy bonds coming out of the Great Recession.
Sure.
So you have to go out along the risk curve, way out, very high on the risk curve, and owning junk bonds basically to try to make your 8%, even though junk bonds yield 5.5%. So you're way out along the risk curve. You own junk bonds, you own equities to really very high proportions. Well, when the next crisis comes, and it's going to happen, these pension funds are going to be insolvent. Social Security, Medicare, public and private CalPERS, all these pension funds are going to be insolvent. Who's going to bail them out? I mean, you're going to have massive people on food stamps if we don't have a bailout. So the free market, the further we get away from the free market, we had an opportunity in 2009 to allow the free market to work, but we decided that would be a really bad idea to let banks that made stupid loans to people who couldn't really afford a house and couldn't afford a mortgage. We came to the idea that it was a really good idea to bail them out. Okay, well, that's QE1. Then we took all the way to 2014. So from 2009 to 2014, we left rates at zero. And then we built up this massive equity bubble. Of course, the bond bubble went into warp drive. Where was the thought that we should, let's return to the free market as soon as possible? Well, now you've gotten so far into the twilight zone that you just can't allow the free market to work without causing a depression to ensue. That's where we are right now. And that's why we have an inflation-deflation portfolio here. Because depending on what they do is where you want to be invested. If they churn to universal basic income and helicopter money and negative nominal interest rates, which is where I'm afraid we're going, well, then you want to be invested along that, and banning physical cash, you want to be invested out along that inflation curve. You want to be hedged towards inflation. And if they actually want to say, okay, you know what, let's let this thing crash, let's default on this debt and start all over again, it's massively deflationary, and you want to be on the left side or the deflation side of that spectrum.
Sure.
In that latter scenario, do you imagine that to also eventually incorporate a reset of the monetary system and the currencies?
Well, we can always hope and pray that's the case. I mean, do you think, the average Joe, I don't even know if they understand what's going on, but I'm hoping that people finally understand, and maybe it's more of a hope, that people understand how important it is to be on a gold standard. And central banks have to act as if they're on a gold standard, if they're not on a de jure, a de facto gold standard. And the reason why is because mining supply sort of mirrors population growth plus productivity growth. So the base money supply never really grows, 15% like it did in the last few years. So if you're growing base money, you break the monetary base. The Fed's balance sheet was $800 billion prior to the Great Recession. Now it grew all the way to $4.5 trillion. I mean, in what world would that ever happen under a gold standard? Never happened. And if banks ever were able to lend this money out, then you'd have hyperinflation. But the real deformation, the real problem is in bond yields. Bond yields, that risk-free sovereign rate, is so distorted and warped. And every asset is priced off of that. So that's why we have these massive bubbles. Real estate's another issue. Equity market is a big problem, as I mentioned, at 1.5 times the economy. But the biggest bubble of all is the sovereign debt market. And that's why when you see yields start ticking up, this inverse volatility index, people were forced into these, I don't say forced, but they were compelled to own these investments that seem to work, seem to make a lot of sense. Well, if the central bank's buying all this debt and stocks is a one-way ticket to go up, then there is no volatility, and there isn't any reason to buy any puts in the stock market. You should be a put seller, not a put buyer, because if you sell a put, they're all going to be expiring worthless. And you should just short volatility because there's no downticks in the stock market. And then when you have the spike in yields, and all of a sudden the risk premium goes from a healthy spread to almost nothing, which is where we're headed, people start selling stocks in a panic. And if the volatility index spikes by 100%, the inverse vol goes to zero. And I'm really afraid that people have piled into passive ETFs like never before. The IMF warned that 22% of corporations, not Michael Pento Portfolio Strategies, IMF, International Monetary Fund, 22% of corporations are vulnerable to going out of business when rates rise. And the Bank of International Settlement says that 10% of corporations don't have the earnings or the cash flow to cover debt service payments. So when rates rise, you're going to see companies, corporations go out of business, layoffs, capital structure will be liquidated, and a lot of these funds that people have parked themselves in, these passive ETFs that pretty much own various forms of the same equities, are all in the same ETFs. And people that have piled themselves into junk bond funds and CLOs, they're going to go no bid. That's what I'm worried about. And maybe it's not a highly probable event. Maybe it's not guaranteed to happen, but it sure as heck isn't something that you shouldn't be worried about. In fact, I think it's more probable than not. So you should be on guard for that.
All right. Well, Michael, thank you so much for joining us today. Just one last quick question about the stock market. Now, in 2008, if we look back at 10 years, when the stock market hit its high, before it crashed significantly, there was a period of, many months before it actually crashed significantly, after it hit its high. So do you see right now kind of a redo of what we saw in 2008? Because we saw the high, about a month ago in the stock market, and then we saw the big correction. Now we're going back up, but are we just going to keep going up, or do you see that this is the time, maybe in a couple months, we're going to see this big crash?
Well, let me try to answer that question. So, come October of this year, the Central Bank of the United States will be selling $600 billion worth, the equivalent of selling. They're not going to sell, but what they don't buy, the Treasury must issue. So you add $600 billion to the annual deficit, plus the $1.2 trillion, you're talking about $1.8 trillion in deficits. Unless the laws of supply and demand have been repealed, and I don't think they have, bond yields are going to go up, and they are probably going to go up dramatically. So I'm looking at the 10-year note, as we talked about in the start of this interview, going to 4%. If that occurs, the risk premium goes to zero. Okay, so you have the inverse of the PE ratio subtracted by the risk-free sovereign bond. If you start getting 3 or 4 rate hikes on the short end, the whole yield curve lifts higher, and you start getting paid, for years and years. You're talking about from 2008 to 2014, 15. You didn't get any money. There was nothing to be made in cash. Putting the money in the bank was just stupid. You had no interest. Now you can make 2% in a very short-term liquid savings account, and don't take any risk at all. If that goes to 3% and the 10-year note goes to 4%, the dividend yield doesn't look very appealing, and the risk premium disappears. So what I'm trying to say is that I think the top has already been put in, if not the absolute top, very close to the top of the stock market has been put in January. And I think as we go through time, as rates continue to rise, you're going to have the progression towards a huge and significant equity market correction, a huge one. Okay, not just 10%, 30% plus. And at that point, I believe that'll be the cap of the 10-year note. That could, for a short time, push people back into bonds after the stock market collapses. But then you have to ask yourself, when the stock market collapses, and we probably will get a recession caused by those higher interest rates, like I mentioned, the housing market already rolling over, and the wealth effect disappears. Then the deficits go from $2 trillion, $1.8 trillion per annum to $2 trillion to $3 trillion. Okay, so now you have a $21 trillion economy that's trying to support $3 trillion in annual deficits on top of the $21 trillion in debt. So there's a chance then that yields don't just go down because the market crapped out and because the economy crapped out. There's a chance, like we had in Greece and in Spain and Portugal and Ireland, that yields just keep going higher. So that's what I think is going to bring the central banks back into the game, and then buying everything. They will do whatever it takes. They will all adopt the Mario Draghi ukase. We are going to buy every sovereign bond we can in sight to try to keep yields from rising. So there's your inflation.
All right. Well, Michael Pento, thank you so much for joining us today.